In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analyst's predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. I am now going to share with you my successful investing strategy for today's company, which is Disney. So stay tuned to find out how to evaluate a business. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. The first pillar we are going to explore is earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. For Disney, this isn't looking too great. For the trailing 12 months, earnings per share has decreased by 28%. Ideally, we would like to see the growth for each of these metrics increase by 10%. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. And here we can see Disney have done particularly well in this area, as their free cash flow is up by a massive 70%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Disney's revenue hasn't increased, as it is 0% for the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value hasn't changed either and is also 0%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are very poor at 1 and 2%. Now we move on to debt. And Joel Greenblatt prefers companies that is able to pay off debt with their free cash flow. Ideally within 3 years, and unfortunately, it would take Disney just over 5.5 years to pay off the debt. At present, these key pillars are not looking too great at the moment. But let's go forward and dig a little deeper. In this next section, we now focus on other key pillars which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently a disappointing 35%, as we would like to see the gross margin over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is poor at just 5% and is well below the ideal 14% we would like. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 4.87%, this looks pretty good. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 4%, with the lowest point being this year at 0%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is minus 58%. Usually, when we create a valuation, I will use the lowest of these two average growth numbers to help project our future stock price. But in this case, I will have to make an exception. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. This is Bitesize Investments, giving you a step-by-step approach on your investment journey. Now let's look at past historical performance, to give us a better understanding of the company's successes or failures the business has been through. Looking at the chart, we can see that when the market dipped in 2020, due to the pandemic, Disney's share price went as low as $86, and then as high as $197 in 2021. However, ever since then the company has been struggling, and in 2023 hit a market low of $78. Then rallied in March of 2024, and is now hovering around the $90 mark. In addition, we can also see the current market cap is about $170 billion. Disney is currently generating $89.2 billion in revenue, and the earnings per share tells us that for each share of stock, the company earned 93 cents in profit. But most interestingly, the current P ratio is 100, which suggests the company is extremely overpriced. Now let's have a look at what the analyst's predictions are, which we should only use as a rough guide when reviewing a stock. On average, the analysts believe that the price target should be about $127, but some believe it can go as high as $145. Analyst reports suggest that Disney is a little undervalued at the moment, and the overall consensus is they are a strong buy. Collectively, the analysts believe the company will continue to grow between 9% and, wait for it, 270% over the next few years. Personally, I don't think so. Looking back over their finances for the past decade, Disney have been struggling since 2020 and don't currently show any signs of recovery at the moment. Now I am going to show you how to create a valuation. I will use the current earnings per share of 0.93. Normally, I would use a combination of the past growth, future analyst predictions, and the average book value for the past 10 years to create the estimated earnings per share growth. But this ranges from -58% to 270%. To create a valuation, I'm going to give Disney a very ambitious 17% growth rate. Then, I am going to give them an estimated PE ratio of 100. I know this is incredibly overpriced, but remember I am just illustrating to you how poor Disney's finances are at the moment. After that, I will project these numbers forward by 10 years. We then need to include a 15% return from our investment. This then gives me an estimated future stock price of about $446 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $110. Then we apply a margin of safety. At 25% it gives me a buy price of about $83. So, let me just recap. To get a good future return on the company, it will have to grow by 17% and have a PE ratio of 100 over the next 10 years. Realistically, this isn't going to happen. Do I think Disney is a good company? Yes, I do. It has some tremendous assets and is a great brand, but is currently going through some terrible issues at the moment, which even the great Bob Iger hasn't been able to resolve. If you found this video useful, please consider giving it a like. The return we would receive if we bought at our 25% margin of safety price of $83 and sold in 10 years' time at our estimated future stock price of $446 would be 437%. But this is dependent on our assumptions for the company being correct. In addition, Disney don't currently offer a dividend. If you have enjoyed this new video format, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Disney scored an abysmal 2 out of 12. So I will give them a cross for this. Their average share price has been in a sideways trend since 2022. And are a far cry away from the dizzy heights of $197 they hit during the pandemic. They are currently down by 37% over the last 5 years. Therefore, I will give them another cross for this. Analysts are signaling Disney is a strong buy, and they are predicting they will grow between 6 and a very unlikely 240% in the next few years. Here they get their first tick. Using the EPS growth model I used earlier on, created a buy price of about $85. But remember, I was using an incredibly high growth number and PE ratio. So take that with a pinch of salt. I personally don't see their share price going much below the $80 mark. Therefore, I will give the valuation a cross. But if you are happy to buy and hold Disney, they could well be a turnaround story and you could perhaps buy them at some bargain prices. As long as you are prepared to go through some pain in the short to medium term. If you would like to find out about my personal portfolio, then click on the link above. According to Morningstar, Disney have a wide economic moat, due to their assets such as their film studios and back catalog of films and programs as well as their parks and resorts. They gain a tick for this. My final overall rating is 2 out of 5 stars. To be honest, the 12 key pillars are essential for me. A company must score over at least 7 of them for me to seriously consider the stock. Therefore, I have given this a category D rating within my own stock watch list. Lastly, these other checklist items are important and are worth considering before purchasing a stock. The first one is to see if there has been any insider buying or selling of shares. This will give us some behind-the-scenes insight on if they are cashing in on stocks before an earnings call or grabbing more stocks before it takes off. Secondly, make sure you keep up to date with the news for any company you are following, so you can better understand why a stock is trading higher or lower. And lastly, conduct your own research. It is important to create your own rationale and thesis for why you are buying into a company, based on your own findings and personal conviction. The book, The Most Important Thing Illuminated, written by Howard Marks, is an excellent read and illustrates the need for rational thought and independent thinking. Click on the link above to listen to the book summary. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating.